So what's the easiest way to get into real estate investment for the long term? You know, I get asked that one way or another all the time. You know, I can tell you the first property that I bought, I was considering a 2 to 4 unit. I went with the 2 unit. Personally, recently sold that after owning it for about 12 years. The 2 unit itself is one of the easiest ways to get into real estate. And I'll tell you why. FHA on a 2 unit does not require any reserves. On top of that, they don't have the FHA self-sufficiency test, which is quite important because the FHA self-sufficiency test requires that 75% of all the market rents in the building will cover the mortgage payment. Well, guess what's been happening lately with higher interest rates in 2022 and 2023? They're not covering the mortgage payment necessarily unless you buy down the interest rate significantly, get large seller credits, buy points, and so forth. So the 2 unit is really big for those 2 reasons. Plus you can use the rental income, 75% of the rental income on the unit you're not occupying to help qualify, which goes against your debt to income ratio and the mortgage payment. So very helpful for those reasons. Only a 3.5% down payment on that, which can come from a gift as well. So again, that is the easiest way. Now, I will mention as well too that the 3 unit is in its own right historically a great option because it's still only 3.5% down. And on 3 to 4 units, that is, they only require 3 months of reserves, and gift money can be utilized for the down payment as well. Seller credit can be utilized for closing costs on all FHA programs. So the biggest difference right there is, of course, the reserves. Now, that can be in the form of non-liquid funds. So maybe it's not a big deal, 401k loan, etc. But with higher interest rates, as I mentioned before about the self-sufficiency test, that's where issues can come in, and you best be talking to a lender that knows what they're talking about when it comes to the self-sufficiency test, because if you don't pass that, then the deal is going to die. And you have already paid for an inspection, which on a multifamily can easily be $500, $600, $700, and then an appraisal, same, you could be out $1,500. So you want to make sure that you have every reason to believe that the market rents are going to pass that self-sufficiency test. You need to make sure you know what the rents are or what they're expected to be. And that's where you need to be speaking to a loan officer that knows what they're talking about. It's very important to know whether or not you can use the current rents or have to use the current rents, whether or not they're tenanted at will or it's vacant, whether or not there's a long-term lease. You got to make sure that self-sufficiency test passes. It is going to be dependent upon exactly where you live, the town, the city, what the market rents are there. And so there's not one black and white answer as to what's going to work. You gotta speak to a local expert, whether or not that's in California or Massachusetts, you gotta speak with that local expert. And last but not least, conventional financing for the first-time home buyer through Freddie Mac and Fannie Mae. They've got a Home Possible and Home Ready option, as well as through housing finance authorities, HFAs, through each state. For us, it's Mass Housing here in Massachusetts. Through Freddie or Fannie directly, or through Mass Housing, as little as 5% down payment on a multifamily. And 3% of that has to come out of your own pocket. So it's very similar to FHA in that regard. I mean, you're off by, if you get 2% gift, you're off by, 0.5% there, or 1.5% between 3.5% and 5%, all very similar. The biggest difference that you're going to find is Fannie Mae, many times you're going to have 6 months reserves. Freddie Mac, with good enough credit, many times you don't have any reserves, both through the HFAs, for us, Mass Housing, or Freddie Mac Direct with their Home Possible program. But that's where you need to get an application in with your loan officer and run the scenarios to see which one works the best. I'll say another big thing here locally is that the Home Possible and Home Ready programs through Fannie and Freddie Direct are limited to 80% area median income. However, the HFAs can actually go higher, and they have relationships and agreements with Freddie and Fannie. So here in Massachusetts, the 100% area median income in Worcester County, for example, is just over $120,000, which is significantly higher than what it is for Freddie Mac and Fannie Mae Home Possible and Home Ready. So you got to know all the little, specifics to make sure that you're in the right product. And so in terms of the 3% out of pocket from borrower contribution, they call it, 2% can come from elsewhere. That includes coming from down payment assistance, for example. So Mass Housing does offer down payment assistance. Sometimes that can actually cover the entire down payment, or the down payment plus even closing costs, depending. On a multifamily, that's just not going to happen, because you got to cover the 3% yourself. Cover 2% of it. Mass Housing does give up to $15,000 on their first-time home buyer program. So let's just say on a $400,000 multifamily, they're only going to cover 2%. So that's $8,000 they're going to cover, right? On $400,000. However, you still got up to $15,000. So you actually have $7,000 access to then apply towards closing costs. So you can still utilize it. You just got to come up with those other funds yourself. So again, these key little elements, and hopefully that gives you value again. I mean, that's my goal here. If you got any questions, please reach out. Chad Rankin, Rankin Mortgage Team, Worcester, Mass. Thank you.